All right, let's get right into it. There's a massive multi-billion-dollar fight happening at the very heart of the crypto world. And it's not about code or blockchains, it's about rules. This battle for regulatory clarity, especially in the United States, is probably the single most important thing shaping the future of digital assets right now. On one side of this fight, you've got the official stance from the SEC. The chairman, Gary Gensler, has been very direct, basically saying there's no problem here. In his words, the clarity is there, the law is clear. I mean, that sounds pretty straightforward, doesn't it? But it begs a huge question. If the law is so crystal clear, then why are we seeing these constant, high-stakes legal showdowns? Why is there this deep uncertainty that has builders and investors pretty much paralyzed? That's really the big question we're going to unpack. And the whole conflict really kicks off with a classic turf war. You can think of it as a tale of two regulators. You've got the SEC, which is in charge of securities, things like stocks and bonds that represent an investment in a company. Then you have the CFTC, and they handle commodities. We're talking basic goods like gold, oil, or corn. So the million-dollar question is, where on earth does crypto fit? Is it a security, a commodity, or maybe something totally new? Well, to even begin to answer that, you have to rewind the clock way back. We're talking nearly 80 years. We need to decode something called the Howey Test. And believe it or not, a 1946 Supreme Court case about Florida orange groves is now at the center of how crypto's future will be decided. So the Howey Test laid out a pretty simple four-part framework to figure out if something is an investment contract, which is just a fancy term for a type of security. First, is there an investment of money? Simple enough. Second, is it in a common enterprise? Third, is there a reasonable expectation of making a profit? And fourth, and this is the big one, are those profits coming from the efforts of other people? If you can check all four of those boxes, the SEC says, congratulations, you've got a security. Now that fourth part, the efforts of others, that's where the rubber really meets the road for crypto. It's almost always the make or break factor. The whole thing boils down to this one question. Does the value of this thing, this token, depend on the essential work of a specific group? A core team of developers, a foundation, a single company pulling the strings? And this comparison makes it super clear. Over on the left, you've got Bitcoin. Who's doing the essential work there? Well, it's a huge, decentralized network of thousands of miners who don't even know each other. Its value is driven by the market. But on the right, think about a typical ICO, an initial coin offering. When you buy into that, you are absolutely betting on a specific team to build out the network, market the token, and actually deliver on what they promised in their white paper. That's a textbook reliance on the efforts of others, and that's what makes it look an awful lot like a security. So that's the theory. But what actually happens when you take this test from the analog era and try to apply it to our crazy digital world? Well, that brings us right to our next section, crypto on trial. For years, the SEC's playbook here has been pretty straightforward and very aggressive. Their position has basically been that most crypto assets, and especially the ones sold in those big ICOs a few years back, are unregistered securities, plain and simple. And this view has led to a whole wave of enforcement actions against crypto projects. But that playbook got seriously challenged in 2023. In the huge case SEC versus Ripple Labs, a judge delivered a really stunning finding. Judge Annalisa Torres wrote that the token itself, XRP, is not in and of itself a contract, transaction, or scheme that embodies the Howey requirements. Wow, that was a massive blow to the SEC's idea that the token is the security. And the ruling was all about the nuance. The big takeaway was it's not about the asset, it's about the transaction. It's about how the thing was sold. So look here, when Ripple sold XRP directly to big institutions with contracts and everything, the court said, yep, that's a security sale. Those investors were clearly counting on Ripple to do the work. But, and this is the key part, when everyday people bought XRP on an exchange through a blind bid and ask system, the court said no. Why? Because the average buyer had no idea if they were buying from Ripple or from someone else. They weren't relying on Ripple in the same way. This ruling also gave a lot of weight to an idea that's been floating around for a while, that an asset can actually evolve. It might start its life looking like a security, during that early fundraising phase when it's totally dependent on its creators. But over time, if the network becomes truly functional and decentralized, and that initial team isn't essential anymore, it could actually transition into being treated more like a commodity. So, the Ripple case definitely shook things up and set a new precedent, but it didn't magically solve all the uncertainty. In fact, it's led a lot of people to ask, okay, is Congress the only real answer here? Which brings us to the big push for a whole new regulatory blueprint. And it's been a long road to get here. It all started with that Howey Test way back in '46. You fast forward to 2017, the SEC's famous Dow report officially applied Howey to ICOs, and that really kicked off this whole era of enforcement. Then, of course, the game-changing Ripple decision in 2023, and all of that has led to where we are now, with this major piece of legislation being proposed, the Financial Innovation and Technology for the 21st Century Act, or FIT21 for short. So what would this thing actually do? Well, the key part is that it tries to end that turf war we talked about. It would give the CFTC the primary job of overseeing digital commodities. The SEC would still regulate assets that are sold as investment contracts. And this is so important, it would create an actual official process for a project to prove its blockchain is mature and decentralized, making that transition from security to commodity a real thing. Okay, so you have the courts making moves and you have Congress trying to write new rules. What does this all mean for the future? Let's break down the outlook and the market impact for everyone involved. And first, let's just be really clear about what's at stake here. We are not talking about some small niche internet hobby. The governance tokens for huge decentralized platforms like Uniswap, Lido, and Aave have market caps in the billions of dollars. Uniswap, $6.4 billion. Lido, $1.5 billion. Aave, $580 million. The outcome of this debate has absolutely massive financial consequences. So, what are the big takeaways? First, regulatory risk is still without a doubt the #1 headwind for the crypto industry in the US. Second, the Ripple case was a turning point because it showed that how an asset is sold is just as important as what it is. This puts regular people trading on exchanges in a much better legal position, though it's not totally settled. And finally, a law like FIT21 would be a gigantic catalyst, but let's be realistic, if or when that will actually pass is still a huge question mark. And that really brings us to the final critical question that's hanging over this entire industry. As this all plays out in courtrooms and in the halls of Congress, what we're really watching is a fundamental clash. Will our laws be forced to adapt to this powerful new technology, or will this technology be forced to cram itself into laws that were written for a world of orange groves and paper stock certificates? This is not financial advice.